What if I told you that, like, one of the most profitable financial platforms in the world doesn't actually make the bulk of its money when you actively trade?
Right, which is completely backwards to how we normally think about it.
Exactly. You usually think of a brokerage as like a toll booth, right? Taking a cut every time a stock changes hands.
Yeah, that's the traditional model.
But when you strip away the marketing and, really look at the actual accounting, the mechanics of modern wealth look entirely different. They make money when you do absolutely nothing at all.
It's true. I mean, the modern brokerage isn't just a conduit for trading anymore. It's this highly optimized, automated ecosystem.
Capturing value from every single dollar.
Exactly. Every dollar sitting in its orbit, whether that dollar is in motion or just sitting perfectly still.
Which brings us to our focus today. Welcome to you, the listener, to today's deep dive. We are unpacking the freshly released Q1 2026 earnings report from Interactive Brokers Group.
Dated April 21, 2026, just for context.
Right. And reading a financial report is usually, as dry as dust. But looking through these numbers, we aren't just doing a postmortem on one company's quarter.
No, that all.
We're looking at a living, breathing thermometer for global market enthusiasm. And looking at the sheer volume of users flooding in, what struck me immediately is this massive disconnect between the headcount and the sheer concentration of wealth those users are bringing with them.
The data bears that out so clearly. I mean, for a firm that has been operating for 4 decades, the year-over-year acceleration is just staggering.
It really is.
We're looking at customer accounts surging by 31% year-over-year.
Wow.
Yeah, bringing them to 4.75 million accounts.
Almost 5 million accounts.
Right. But total customer equity actually outpaced that headcount growth significantly. It skyrocketed 38% to hit $789.4 billion.
Wait, nearly $800 billion sitting on the platform?
Yep. Almost $1 trillion in customer equity.
Okay, let's unpack this because, having $800 billion aggregated in one place doesn't inherently mean the brokerage is making a killing.
Right, exactly.
Like if I think about it as a nightclub, it's like a nightclub that not only expanded its VIP list by a third, but then discovered every single VIP is suddenly spending 38% more at the bar.
That's a great way to look at it.
But I have to ask, what is driving this sudden influx? Are people just fleeing to safety? Parking their money in a digital vault to weather macroeconomic uncertainty? Or are they actively making moves?
Well, we see the answer to that directly in a metric called DARTs.
DARTs.
Yeah, daily average revenue trades. This is the crucial filter in the brokerage industry.
Because it cuts through the noise.
Exactly. It strips away all the institutional routing noise, the zero-fee promotional fluff, and counts only the executions that actually generate commission revenue for the firm.
Oh, gotcha. And how did those look?
Total DARTs jumped 24% year-over-year to 4.37 million.
Over 4 million revenue-generating executions every single day.
Every single day. What's fascinating here is that the breadth of that activity proves this isn't just a localized meme stock phenomenon or passive holding.
Right. It's not just one crazy asset.
No. Customer trading volume in equities specifically was up 25%, with 116.9 million stock shares traded in the first quarter alone.
That is massive.
And futures volume jumped 20%. Options contracts were up 16%.
So they're trading everything.
Yeah, these investors are highly engaged. They're actively utilizing Interactive Brokers' automated architecture to deploy complex multi-asset strategies.
Across their whole global network, right?
What? Across the 170-plus global markets that the platform provides access to.
Man. With 4 million revenue-generating trades happening daily, it is so easy to get distracted by the action.
Oh, totally. The volume is loud.
Yeah, you see volume spiking across options, futures, and stocks, and you assume the trading commissions are the absolute center of gravity for their balance sheet.
Which is what most people think.
Exactly. But looking closely at the income statement, I realized we might be focusing on the wrong cash cow entirely.
The real story isn't the money in motion.
No, it's the money sitting perfectly still between those trades. Here's where it gets really interesting.
Got it.
So their commission revenue did grow nicely, right?
Yeah.
Up 19% to $613 million for the quarter.
A very solid quarter for commissions.
Very solid. But then you look one line down at net interest income. It completely dwarfed those commissions. It rose 17% to a staggering $904 million.
Yeah. That is the hidden engine of modern finance right there.
earning nearly $1 billion in a single quarter strictly from the interest rate spread.
It's wild, right?
It fundamentally changes how you view the business model. It's like a massive casino where the house isn't just taking a statistical edge on the games being played.
Right.
The house is actually generating massive interest off the plastic chips just sitting in the players' pockets while they walk around the floor.
Oh,
Or while they borrow chips to play at a higher stakes table.
that's spot on.
But wait, so they made almost $300 million more from interest than from actual trading fees. Are they a broker or a bank? How exactly are they pulling that much out of thin air just from people having, quote, credit balances?
To understand that, we have to look at the mechanics of the two massive opposing pools of capital that brokerages manage.
Okay, leverage and idle cash.
Exactly. The first pool is margin lending. So in Q1, customer margin loans jumped 35% to $86.0 billion.
Wait, $86 billion. That's capital that Interactive Brokers is lending out to users who want to amplify their positions.
Yep. And they're collecting a premium on every single dollar of it. The report shows they're earning an annualized yield of 4.11% on those customer margin loans.
So that's the leverage side. What about the idle cash?
That's the second pool of capital, and it's where the sheer scale of the platform really flexes its muscle. Customer credit balances, which is the uninvested cash sitting in accounts, rose 35% to $168.8 billion.
Oh, wow. So if you are listening to this right now and you have uninvested cash sitting in your brokerage app waiting for a pullback in the market,
You are part of this $168 billion pool.
that is insane.
And here is the kicker. They don't just leave it sitting idle. They utilize sweep networks.
Sweep networks.
Yeah. Interactive Brokers takes those massive credit balances and sweeps them into a network of partner FDIC-insured banks. Or they hold short-duration government securities.
Ah, so they're putting it to work.
Exactly. By doing this, they earned a 3.30% annualized yield on segregated cash and securities this quarter.
So they're capturing the institutional yield spread.
Right. They pay the end user a portion of that yield, obviously, but they retain a massive cut simply for facilitating the aggregation of that capital.
That is an incredibly resilient floor for their revenue because, I mean, if volatility drops and trading volumes dry up next quarter, those commissions will take a hit, right?
For sure, commissions would drop.
But as long as interest rates remain elevated, that $168 billion in idle cash is still going to quietly churn out millions of dollars a day in net interest income.
Yep. Exactly. The trading platform basically acts as the highly visible, frictionless storefront that acquires the users and their assets.
And the net interest margin is the invisible vault in the back room generating the real wealth.
Regardless of market direction.
Wow, so that massive interest engine, combined with the spike in trading volume, brings us to the bottom line, over $1.67 billion in GAAP net revenues.
Or $1.68 billion on an adjusted basis.
Right, but, earning revenue is one thing. The real shocker for me in this report was how much of it they actually get to keep.
The margins are unbelievable.
The pre-tax profit margin for the quarter hit a massive 77%. That's both on a GAAP and an adjusted basis.
Up from 74% a year ago. I mean, a 77% profit margin in the financial services sector is an extreme outlier.
It really is.
That efficiency translated to an adjusted diluted earnings per share of 69 cents.
And GAAP EPS was 59 cents, right?
Correct. And it allowed them to confidently raise their quarterly dividend from 8 cents to 8.75 cents per share.
Which is great for shareholders. But usually when your physical output scales, like when you process 24% more trades and handle 31% more accounts, your operational costs scale in tandem.
You'd expect them to, yeah.
But looking at their expense sheet, their execution, clearing, and distribution fees actually decreased by 12%.
Dropping all the way down to $106 million.
Right. So what does this all mean? It's like running a global delivery business where you're delivering 25% more packages, but your fuel costs actually went down because the government removed all the highway toll booths.
That's actually a very accurate analogy.
Yeah.
The report cites two major reasons for this cost drop.
The SEC fee and the liquidity rebate.
Exactly. The SEC Section 31 transaction fee rate dropping to zero and the capture of greater liquidity rebates.
Let's break those down because they sound like dense regulatory jargon, but they're actually fascinating structural advantages.
Okay, let's start with the SEC Section 31 fee. This is a vital mechanism of U.S. market plumbing.
My understanding is that the SEC charges this fee to brokerages to recover the costs of the government, like supervising and regulating the national securities markets.
Right. But it isn't a fixed, static percentage.
Wait, really?
It changes.
Yeah. By law, the SEC sets a target revenue amount they need to collect for the year. If overall market trading volume absolutely explodes like we saw with these record Q1 numbers, the SEC hits their congressionally mandated revenue target way ahead of schedule.
Oh, so they're legally required to adjust the fee rate downward.
Exactly. And back on May 14th, 2025, that rate actually hit zero.
Zero.
Which acts as an immediate massive reduction in variable costs for high-volume brokers like Interactive Brokers.
Okay, but what about the second factor, the liquidity rebates?
That one is even more structural to their specific operating model. This comes down to the maker-taker pricing model used by major stock exchanges.
Meaning the exchanges actually pay brokers to route orders to them?
Under certain conditions, yes. Exchanges need liquidity. They need resting limit orders on their books to ensure smooth, continuous trading. Right.
So they charge a fee to the takers of liquidity, the people placing market orders who want immediate execution.
Because they're taking shares off the board?
Exactly.
Yeah.
But they offer a financial rebate to the makers of liquidity, the brokers who route limit orders that sit on the book and provide that depth.
Ah, okay.
Because Interactive Brokers pushed such a staggering volume of trades through their automated routing systems this quarter, they optimized for these maker rebates. The exchanges were essentially paying them to provide volume.
Driving their net execution costs down significantly.
Exactly.
Okay, but I have to push back on the sustainability of this. I mean, a 77% margin is practically unheard of outside of like pure play enterprise software.
It's extremely rare.
Is this a permanent new normal, or is this just a temporary sugar high from the SEC dropping that Section 31 fee? Like, once the SEC resets that fee, does the margin collapse?
If we connect this to the bigger picture, we see that while the zeroed-out SEC fee is a fantastic tailwind, it's not the foundational engine of their efficiency.
Okay, so what is?
The true driver of that 77% margin is their 4 decades of relentless focus on automation. They haven't just built a customer-facing trading interface. They've built a scalable infrastructure layer.
So they're operating as a pure technology company that just happens to clear trades.
Exactly. Consider the traditional banking or brokerage model. If a legacy firm suddenly acquires 31% more accounts, they face immense friction.
Yeah, they have to hire massive waves of customer service reps.
Expand physical real estate, upgrade fragmented legacy IT systems to handle the load. Their fixed costs rise aggressively to meet the new revenue.
Right.
But Interactive Brokers relies on programmatic onboarding and automated data routing. The marginal cost of adding their 4.7 millionth customer or processing their 4 millionth trade on a Tuesday afternoon, it approaches zero.
Man, that operational leverage is what allows them to drop so much of that $1.67 billion in revenue straight to the bottom line.
Building a total equity fortress that currently sits at $21.3 billion.
$21.3 billion in total equity. But, digging into the footnotes of the comprehensive income statement, I found a highly unusual quirk in how they manage the risk around that massive equity fortress.
Ah, yes. The global basket.
Yeah. And this strategy actually cost them money this quarter.
It did. It's a masterclass in macroeconomic risk management, but it often creates counterintuitive quarterly accounting optics.
It really does. I mean, most U.S.-based publicly traded companies simply denominate and protect their net worth in U.S. dollars.
Because it's the default.
Exactly. But Interactive Brokers doesn't do that. They base their net worth in something they literally invented called the global.
Which is a proprietary custom basket of 10 major global currencies.
Right. And because the relative U.S. dollar value of this 10-currency basket decreased by about 0.30% this quarter, the strategy actively decreased their comprehensive earnings by $53 million.
The accounting presentation of this mechanism is actually split across the statements because of how currency translation is handled under standard rules.
Right, yeah. The report shows it was reported as a $26 million gain in other income, but a $79 million loss sitting down in other comprehensive income.
Which nets out to that $53 million hit to their overall comprehensive earnings.
Right. So my question is, they essentially took a $53 million hit to their earnings just because they didn't want to keep all their eggs in the U.S. dollar basket.
Basically, yes.
That feels totally counterintuitive. Why overcomplicate things with a 10-currency synthetic basket when they are doing so well? Like, you're generating billions in pure interest and commissions in dollars.
This raises an important question, though, about the fundamental difference between a domestic operational mindset and a truly global one.
Okay, how so?
It's incredibly easy to look at a $53 million comprehensive loss on a spreadsheet and assume they made a hedging error. But you have to look at the reality of their footprint.
They operate everywhere.
Right. For a truly global broker operating across multiple currencies, providing direct execution and custody across more than 170 markets, this is a vital shield.
Because they're deeply embedded in European, Asian, and emerging market clearinghouses.
Exactly. They have to maintain massive pools of local currency in dozens of foreign jurisdictions just to satisfy local regulatory capital requirements and settle trades.
Ah, okay.
And that creates a massive systemic vulnerability if they view their wealth strictly through the lens of the US dollar. If they held their entire $21.3 billion equity solely in dollars, a sudden, violent devaluation of the dollar against global currencies would severely impair their purchasing power.
And their operational liquidity in those 170 foreign markets.
Precisely. Conversely, if they held all their equity purely in the local currencies of their diverse client base, they'd be constantly exposed to the collapse of any single emerging market's monetary system.
Oh, I see. So the global basket is a structural shock absorber. It's a lesson in long-term risk management versus short-term quarterly gains.
Exactly. By pegging their aggregate net worth to a diversified basket of 10 major currencies, they protect the entire company from the potential volatility or collapse of any single currency.
Even if it costs them $53 million this quarter.
Right. It occasionally costs them optical points when the translation math swings against them, but structurally, it's an insurance policy. They're deliberately choosing long-term survival over short-term earnings perfection.
That completely reframes the entire quarter for me. It's not an accounting mistake. It's a deep structural moat they have dug around their balance sheet.
It really is.
Well, this has been an incredibly revealing look under the hood of what initially appeared to be just a dense stack of financial tables. Let's briefly recap the journey for you today.
Feels good.
We started by exploring the explosive 31% growth in accounts, visualizing a market where almost $800 billion in customer equity isn't just hiding in cash, but actively generating over 4 million trades a day.
And then we uncovered the true economic driver of the platform, that hidden $904 million net interest engine.
Which was eye-opening.
Yeah, we broke down how sweeping $168 billion in idle cash and yielding 4.11% on massive margin loans allows them to operate with the steady mechanics of a bank.
Then we marveled at how execution costs actually fell 12% in the face of record volume, achieving a staggering 77% profit margin, aided by those zeroed-out SEC fees and liquidity rebates.
And finally, we dissected their unique 10-currency global risk strategy and that $53 million accounting hit.
Proving they are playing a defensive, decades-long game.
It paints a picture of a beautifully oiled, 77% margin machine that captures value at every possible vector. It profits massively whether you trade actively or whether you just sit on cash and borrow.
But I know you had a final thought you wanted to leave the listener with today.
I do. We've seen how Interactive Brokers has built this incredible ecosystem. But as modern brokerages become increasingly automated, acting as tech companies, banks, and global currency hedges all rolled into one case, what happens to this ecosystem if global market volatility suddenly dries up? It forces us to ask, who really holds the systemic power in the future of finance? Is it the individual trader making the decisions, or is it the overarching platform?
Wow. The thermometer might actually be running the climate control system. That is an incredible thought to walk away with. Thank you to you, the listener, for joining us on this deep dive. Keep exploring the underlying systems, and most importantly, keep asking the big questions.